everyone, I'm Payel Farasat, Chief Investment Officer of Loring Ward. In this segment of Making Sense of Markets for the third quarter of 2016, I will focus on new analysis that explains and supports our long-term investment philosophy. My team conducted a simple yet powerful and practical exercise where we checked how well the key factors or premiums that we pursue in our models have showed up in your portfolios historically over the long term. Now, before we jump into the results of our analysis, please bear with me for just a few minutes as I set the stage to discuss our new analysis. First, let's do a quick recap of what the terms factor and premium mean and why they matter to your portfolio. Simply put, a factor is a characteristic of a stock that tends to pay off more in the long run than a stock without that characteristic. Such factors or characteristics could be as simple as the size of a company or whether a company is in the value stage of its life cycle as opposed to the growth stage and other things like that. Now, the amount of extra payoff that you get from investing or tilting towards these factors is simply called the premium or factor premium. What I will showcase to you today is some historical evidence we have found of how big these premiums can get, especially if you stay invested and stick with the investing program long enough. In this quarter's presentation, we will start by looking at one factor, value, and we will take a deeper dive into two value segments. One, the value premium that can be found in certain stocks in the U.S., and two, the value premium that can be found outside the U.S. in certain stocks in developed countries across the globe. And one last thing before we turn to the results. We have talked to you before about these factors and premiums. However, today's discussion looks through a different lens, and we will provide you with a new way of presenting the premium information. In this new approach, we're going to look at each premium like before, but now we have it broken out into two realistic ways on how the premium might be achievable in the real world. One, by an index allocation program, where, for example, a value-oriented ETF allocation manager might tilt more towards index-based definitions of value over growth. We call this the index approach in this segment. As compared to our approach to pursue the same factor and same premium, but to try to squeeze out on your behalf even more premium out of the same factor exposure through our use of DFA as the manager and their unique implementation approach. So what's unique about our approach? One, we do way more than simply hold a long-term overweight to a factor, whereas an indexer would simply do just that. They would hold a long-term index overweight to an index-defined factor. Speaking of definitions and universes, we track through DFA a more custom, that is, strategically defined universe of securities. Say what a value stock might mean to us through DFA versus what an index would define or classify as quote-unquote value. We are able to take advantage of DFA's ability to trade patiently and continuously rebalance, that is, continuously make portfolio adjustments as needed over time without being handcuffed by strict index annual reconstitutions or rebalances that an index is of course bound to do. And therefore, on your behalf, we are able to capture for you the annual index reconstitution effect or expense that we believe indexers inevitably pay up and suffer through each year, especially through the factors that we will be talking about. We aim to capture and put that extra premium back in your pocket. We're also able to take advantage of DFA's selectivity and avoidance of many unhelpful exposures, such as their exclusion of real estate from within their equity strategies, exclusion of highly regulated utilities from within their value strategies, exclusion of securities with a high degree of uncertainty, like those going through mergers and acquisitions, or those suffering very low liquidity. Let's put it this way. Indexers would hold these unhelpful sectors through, say, their value exposure simply because their value yardstick is very simple. And so they may mindlessly include unhelpful sectors that generally don't behave like true value stocks. And last but not least, we are able to pursue and extract multiple premiums at the same time in your portfolio. DFA does a great job of quantitatively deciding how much of each premium should be pursued. Again, something indexers don't do, or if they do it, it's more of a sledgehammer approach compared to DFA's scalpel approach to the same thing. So now, let's turn our review of the value premium both domestically and internationally. Thanks to the hard work of my staff, we can now illustrate for you the actual historical additional amount of premium from our value factor exposure over and above what indexers might accomplish. The results, as you will see next, is that historically we have seen a distinct advantage of our approach of extracting the value premium through a solid track record of beating the broad market index using DFA's investing process. First, let's focus on the domestic value premium, which simply is the premium we believe that can be found in U.S. value stocks relative to U.S. growth stocks over time. As you can see, an index approach is simply tilting towards a U.S. value factor, or U.S. value stocks, as defined by the Russell indices, generated about 98 basis points over the period of time since the inception of DFA's Large Cap Value Fund in 1993. However, the DFA Large Cap Value Fund outperformed the Russell 1000 Growth Index by 134 basis points during the same period, showing us that we captured the U.S. value premium more effectively than a simple index approach over that same historical period. Almost as importantly, I would note, the correlation of our premium capture approach against market moves in the broad market was very low. This is important because it suggests that there was no predictive association of how strong or weak the market was with the historical success of our approach. Bottom line, based on the history we see, we find no evidence that someone could time the U.S. value premium against the market, which suggests to us that the best course of action to collect the U.S. value premium through our approach was to stay invested in the DFA Large Cap Value Fund regardless of how the market moved in the short run. Since the inception of the DFA Large Cap Value Fund in 1993, as you can see in this chart, we find that the growth of $10,000 in that fund has significantly outpaced the growth of an identical $10,000 if it could be invested in the Russell 1000 Growth Index. Now please note that the U.S. value premium has not always been positive, nor is it expected to be. Since the inception of the fund in 1993, there have been many months when it has been negative. But what we have also found was that almost 77% of the time, when the value premium turned negative in any given month, it took 2 months or less to show another positive reading during the period studied. Historically, since the 1993 inception, the DFA Large Cap Value Fund has outperformed the Russell 1000 Growth Index just over half of all possible rolling one-year periods. However, the longer the rolling time frame you look at historically, the higher the likelihood of outperformance. That is, the higher the hit ratio gets generally. Based on history over a 10-year investment horizon, U.S. value, on average, has outperformed growth, the Russell 1000 Growth Index, 84% of the time. Similarly, using the same historical time periods, we calculated the historical size of the U.S. value premium. It shows that a similar benefit occurred. Not only did the data show a greater likelihood of outperforming the Russell 1000 Growth Index, as seen in the last slide, but the data also showed that the size of the U.S. value premium, even when annualized to a single year's average return, got larger the longer the rolling period studied generally. Looking at the longest rolling time period studied, the 10-year horizon, we see that historically, since 1993 inception, the DFA Large Cap Value Fund has outperformed the Russell 1000 Growth Index by 3.4% per year over 10-year rolling periods. Bottom line, the longer you wait for the U.S. value premium to develop, the larger the annual average premium has been historically. However, please note that the U.S. value premium can shift dramatically from month to month, as shown in this chart, which looks back at the most recent 18 months of rolling performance. Year-to-date in 2016, the U.S. value premium has been positive 2.29% so far. However, we remind everyone to not fixate on short-run numbers, but to keep their eye on the long haul instead. That was a look at the U.S. value premium. Let's take a similar look at the value premium in the non-U.S. developed markets around the world. That is the international value premium using the same model. As you can see, an index approach of simply tilting towards an international value factor or international value stocks as defined by the MSCI indices generated about 136 basis points over the time period since 1994, which was the inception of DFA's International Large Cap Value Mutual Fund. However, the DFA fund outperformed the MSCI World ex-USA Growth Index by 179 basis points during the same period, showing us that we captured the international value premium more effectively than a simple index approach over the same historical period. And as with the domestic pursuit of the value premium, I would note that the correlation of our approach against moves in the broad market was very low. Again, this is important because it suggests that there was, again, no predictive power between broad market performance and the historical success of our approach. The bottom line remains unchanged. Based on the history we see, we find no evidence again that someone could time the international value premium against the market, which suggests to us that the best course of action to collect the international value premium through our approach was to stay invested in the DFA International Large Cap Value Fund, regardless of the short-run market movements. As you can see here, since the inception date of 1994 of the DFA International Large Cap Value Fund, the growth of $10,000 in that fund has significantly outpaced the growth of an identical $10,000 if it could have been invested in the MSCI World ex-USA Growth Index. As we showed with the U.S. value premium, please note that the DFA International Value Premium has not always been positive, and nor is it expected to be. Since the inception of the fund in 1994, there have been many months when it has been negative, but almost 78% of the time, the DFA International Value Premium rebounded to positive in 2 months or less during the period studied. Generally speaking, the International Value Premium does not stay negative for long, at least on a monthly basis looking back historically. Now, while this data is independent of the comparable U.S. data, it is very indicative of the general behavior of the value premium globally. Now, historically, since the 1994 inception, the DFA International Large Cap Value Fund has outperformed the MSCI World ex-USA Growth Index just over half of all possible one-year periods. However, the longer the rolling time period you look at, historically, the higher the likelihood of outperformance. That is, the higher the hit ratio gets generally. Based on history, a 10-year investment horizon, the international value premium on average has outperformed MSCI World ex-USA Growth Index 84% of the time. Again, our numbers for international value mirror what we saw for domestic value. The longer your investment time horizon, the longer you stay invested, the longer you allow the premium to develop, the greater your chances are of acquiring the premium. Similarly, using the same historical rolling time periods that we used to calculate the hit ratios in the previous slide, we calculated the historical size of the DFA International Value Premium. It shows the occurrence of a similar benefit. Not only did the data show a greater likelihood of outperforming the MSCI World ex-USA Growth Index on the last slide, but the data also showed that the size of the international value premium can vary. Even when annualized to a single year's average return, the premium got larger the longer the rolling period studied, generally speaking, with the exception of the anomalous 3-year holding period. Looking at the longest rolling time period studied, the 10-year horizon, we see that historically, since 1994 inception, the DFA International Large Cap Value Fund has outperformed MSCI World ex-USA Growth Index by 4.8% per year over 10-year rolling periods. However, again, please note that the international value premium can shift dramatically from month to month. As we can see from this table of the last 18 months of rolling performance, the international value premium has struggled a bit to remain positive. Year to date in 2016, the international value premium has been negative 2.16% so far. As our earlier slides show, these periods of weakness are expected and they appear to be, over the long run, temporary. Therefore, we again remind everyone to focus on the long-term investment philosophy and to never fixate on any short-run numbers. We hope that all three of our Q3 2016 segments have been helpful to you in making sense of markets and headlines this past quarter, while reinforcing our long-term investment philosophy on the key premiums that we pursue in our model portfolios. Be sure to turn in next quarter when we cover how the small cap premium delivered domestically and internationally and why it matters to you as an investor.